All right, everybody. Welcome to the podcast. We are here. My name is Kurt with Mamba Mortgage. We are here with our expert in credit today, Colby Hurford. I'm so excited to have him here. Colby, thank you so much for being here. Now, I want to let everybody know, we've talked about this. I keep finding all these golf gurus, right? Colby might be the best golfer I know personally, right? So we're going out there. I'm finding a really good scramble team that I can just hang with. That's really the goal. So also a couple things about Colby. Man, he's been in the real estate business for a while, and I'll let him kind of touch on that. But two, he loves long walks on the beach. That's one of his favorite things in his spare time. So you'll have to ask or leave a comment about that because, man, it's incredible. Colby, tell us a little bit about yourself, brother.
Yeah, appreciate it, Kurt. Glad to be here. So I've been with the mortgage industry now for 13 years. Started off as a loan officer for about a year and then transitioned my old company to a corporate trainer. And so where my passion for credit comes from is that really the basis of what I've done for the last decade plus has been around educating consumers. And especially those of which that don't qualify. And obviously anybody that has worked in this industry knows that there's a lot more people that don't qualify that do. Just kind of happens to be that way. And mostly all the reasons, or 90% of the reasons, are because of credit. And so it is as nerdy and as passion can be, as that word can be when talking about credit.
Right.
I think it's just because there's just a tremendous amount of value due to the lack of knowledge across the way, where credit impacts literally everything in our lives, but nobody really knows what it is, what it's about, how it impacts me, what can I do, what should I not do. And it's not like they taught us that in school along with taxes and right. But at least I know what the Pythagorean theorem is, you know?
Right.
So
is that A squared plus B squared equals C squared?
I have no clue.
Oh,
No clue.
Look, we're pretty much math whizzes in certain realms.
So I have a calculator.
Right, exactly. Calculators work great.
Yeah.
So another thing I want to tell you guys about Colby, he is one of the best, and when I say the best, I truly mean this, at like encouraging people and getting people excited. I will say, being at Mamba Mortgage, man, it has been a blast just to get a hang with Colby, and man, the amount of times I've walked out of his office on our one-on-ones and just been like, bro, I'm so hyped up right now. I feel like I should just go sprint, or man, I just need to go run through a wall like the Kool-Aid man. So Colby, thank you for your energy, brother. I appreciate what you're doing. But let's jump into it, man. So I'm going to start simple. What exactly is credit, and why does it matter so much in everyday life?
Yeah, so it's a complex question. What exactly is credit? And if you chat GPT that, you're going to get a laundry list of different things, but really, credit is not only your ability to borrow money, but it's a risk assessment based on your track record of how you've borrowed money. And that's what a credit score is. And so that's the shortest way to talk about it, and how it affects us every single day is that credit score can impact you on insurance premiums. Credit score can impact you on obviously getting qualified for different amounts of credit, whether it be a credit card, whether it's a personal loan, a student loan, a car loan, a mortgage that we're going to talk about. But then also it can impact you just from a job perspective. A lot of places do credit and background checks. And I know within this industry, like you can't work in this industry if you have certain things on your credit. So credit sometimes also can prevent you from getting a job if you do not have, the right things in place.
No, that is super powerful. And again, I think all of us learning the basics of credit can help us take everything to another level. Obviously, we're biased towards real estate market and the real estate world as mortgage lenders. So please tell me a little bit about how credit is related to real estate and mortgages.
Yeah. So, ultimately, I call it the first gate that a person has to cross, right? This first point of entry. There's a lot of different ways in which you can qualify for a mortgage, whether you're buying a home or refinancing your home, whether it's a primary residence, whether it's a investment property or anything else. But credit is like the first path that you have to get through.
Yeah.
And it varies based on the products. It varies based off of who's pulling it. but credit is that first piece. And without credit, it doesn't matter if you make $1 million. It doesn't matter if your debt to income ratio is, 5%. If you have a, 500 credit score, it's gonna be difficult to get approved for anything, no matter how much money you have.
So what would you say we'll just say the everyday person, let's say we'll do two different ones. We're going for real estate investor, but also your first time home buyer. What should be a number that people are trying to strive to be able to get up to put them in the best situation? And
Yeah.
again, doesn't mean obviously that nothing's going to happen with that, but what's going to put them in the best situation?
Yeah, and it varies based on the product. And I think that's the big thing that a lot of people don't understand. And, we get customers all the time that say, I want an FHA loan or I want a VA loan. And they don't know anything about the products themselves. They just saw one blip of a commercial or an ad or somebody that they knew that had it and like, oh, I want that too. And the thing is that for every single loan product, conventional FHA, and just talk about like DSCR, so a very heavy investor type product, the credit score requirements are different. And so for, a regular conventional loan, you're not going to be able to really go below 620 because conventional loans are regulated by Fannie Mae.
Yeah.
And so that is like across the board. And so there's not any real wiggle room in what places can offer. Like that's the minimum you need. You may come across certain institutions that demand you to have a 660 or 680. When we dealt with COVID, that was a totally different sphere of, how the industry could regulate and would regulate. And there are times where we had, in order to refinance your house, you had to have a minimum of 700.
Yeah.
And so it is very fluid, but overall for conventional loans, it's 620. FHA loans, because they are backed by the government, you can go all the way down to 500, provided you have to find a lender that's willing to go down that way. Obviously there's higher risk with lower credit scores. And then for just investment properties in general, I said DSCR, and for a lot of people don't know what DSCR is. It's just a specific investor product. But most investor loans, you're going to have at least a minimum of 660.
Yeah.
Again, you may have to go higher depending on who you talk to, but that's typically it. So if you're around this high 607s, you're going to be in good shape to really be able to qualify for anything on a credit standpoint.
Love that. So it is the exact opposite of my golf game, right? We don't want the lower number. So the way I look at it in my golf game is by me having a higher score, it's pretty much better, just like credit. Okay. That's how I'm going to look at it. Also, this came across my mind. I thought I'd share this with you too. In golf, right? You being a better golfer, right? You get to play less golf than I do, right? So by having a worse score or a higher score, I just get to play more golf. That's how I'm looking at that. So I think that is important to know. Complete sidebar. Sorry. I get distracted pretty easily. So
I think too, but to also kind of speak to that too, Kurt, is I ran into this a lot because predominantly throughout my career, now that I'm at Mambo, we're very much more purchase focused, whether primary residences or investment properties. But my previous life, we're very heavy on the refinance side of things. And so what we would sometimes run into is that people and say the more like 60 plus years of age, a lot of folks that had probably paid off their house, 10, 15 years ago, pay a lot of cash for everything. And then we go and pull their credit and they don't have a credit score. And they're like, well, why don't I have a credit score? Well, it's because you haven't borrowed any money. Yeah. That's the thing. So if you don't borrow anything, right? Everyone talks about, there's a lot of financial experts out there like, hey, pay cash for everything. Yeah, until you need to get approved or need to borrow money. And then you're in a tough spot. Yeah. And so we had to sometimes educate people like, hey, you need to open up a, gas card, Kroger, gas card as an example with a small balance and get some history to it so you can build a credit score. And a lot of people just don't know that paying cash actually doesn't do anything for your credit. And even if you don't have any accounts, or I had an account, but it closed 7 years ago, but I haven't had anything since, you probably don't have a credit score, which means you're not going to qualify for anything.
Okay. Now that's a beautiful thing to think about, is because not having credit is just as bad as having a low credit score, right? Because then it's hard to have an approval with that.
Mhm.
What are some other ways that we can kind of build on credit? Obviously, for those scenarios, and then what are some things that people can do that already have maybe bad credit that we can do to kind of improve that?
Yeah, so the credit scores made up of really like five different components, and what impacts your score, right? And the big thing, and everybody knows, is payment history. That's like number one, muy importante,
Yeah.
credit history. I always say there's nothing that'll ruin a good credit score worse than a late payment.
Mm-hmm.
Period. No matter what it is, doesn't matter if it's on
Yeah.
a $25 credit card bill or a $1,500 mortgage bill. You got to pay your stuff on time. That incorporates right around 35% of what makes up your credit score is
Mm-hmm.
payment history. Everybody knows that, right? If I
Yeah.
we poll all of America, like, what do you know about credit? And they're like, make my payments on time. Like,
Yeah.
boom, good. The second one is the one where people truly don't know, and don't have a lot of, it makes sense when you think about it, but because people have never been taught about it, they don't really think about it that way. So it's credit utilization. 30% of your score is dictated by credit utilization. So what that means is, on a credit card, as an example,
Mm-hmm.
if you have a $1,000 limit, but you owe $950
Yeah.
on that $1,000 limit, there's not a lot of wiggle room there. The credit bureaus will look at that and go, "Uh-oh, that's a little risky," because they're utilizing the credit and utilizing it too much. And so we actually call it the 30% rule, and it just happens to be 30% of what makes up credit score, is that for any amount of revolving debt that people have, you want to have no more than 30% owed
That makes sense.
on all the debt. So again, on a $1,000 credit card, you want to have a balance of $300 or less. And so that's where really the biggest value that I've seen in the coaching that I've given loan officers throughout the years is talking to people about utilization, because they'll get that customer that says, "Well, I don't understand why my credit is only a 610 because I have 15 credit cards open and I make all the
Mm-hmm.
payments on time." Yeah, but out of those 15 credit cards, 10 of them are at 90% utilization. And so the credit bureaus are looking at this. And again, if you think of a credit score as just a risk assessment, how risky are you to lend money to?
Yeah.
That makes sense why the credit score isn't good, right?
Right.
And so that's where a lot of times we'll have to educate the people, like, hey, pay these things down. Or when we talk to them, especially doing something like a refinance, it's the easiest way to jump your credit by taking this compounding interest revolving debt at 25%. And even in today's market, turning into 6-7%
Yeah.
mortgage debt. Not only are you going to save hundreds of dollars on a monthly basis, but your credit is going to go skyrocketing, because now all of a sudden you're taking those 90%
Mm-hmm.
utilization cards and you're turning it to zero. And the credit bureaus love to see that you have lots of credit available to you, but you know how to use it responsibly.
Right.
Again, that goes with the risk assessment.
Right. And then taking that too and finding a good way to use that money appropriately to put yourself in a great situation,
Yeah.
right? So bringing those numbers down so your payments are less, but then also taking you back up so you can reinvest that money, save for college funds,
Yep.
any of those things, right? And that is such a powerful thing to be able to do.
Yeah.
Um,
A couple of other things that are smaller. Obviously, that's about 65% of what makes up credit scores, but new accounts. So length of credit history
Mm.
plays a big part too. The older your accounts are, the higher your credit's going to go, because again, if you think back to what we first talked about, credit is the history of how
Yeah.
you manage your debt. And so if you have a card that is 25 years old, keep that card open. If you're going to close any account, which I don't necessarily agree that anybody should close accounts, you definitely don't want to close the oldest account, because average age of your accounts does dictate your credit
Yeah.
score. So that's something that comes in. And then just inquiries. That's a big one too that people don't think about, is just inquiries, and specifically hard inquiries that you're going to get whenever you apply and get credit cards, student loans, like anything that you're applying for, anything that you're borrowing money for, to get that debt in the end. 95% of the time, you're going to have a hard credit pull. And those inquiries over time, because it tells the bureaus, you're looking for money, you're looking for money, you're looking
Right.
for money, your score is going to go down.
Right. No, that makes a lot of sense. I think there's a lot of value in that too. And Colby and I have talked about this several times. It's something that he preaches. And here at Mamba Mortgage, what we want to strive to do is not just be a loan officer, but a loan advisor, right? Putting people, yourselves, in the best position to be able to be successful, save money appropriately, and again, really be able to generate wealth long term. And again, just enjoy your life while you're also going through and living it, right?
Yep.
Because life's hard enough.
Yeah.
Right. So that is really a big goal here. Colby, do you have anything else specifically that you think is really important for our listeners to understand about credit before we kind of wrap up here?
No, I mean, I think the biggest thing is, in ways in which you can protect yourself. I think you can go online to any of the three credit bureaus, TransUnion, Equifax, or Experian. You can go online and put an online freeze. A lot of people worry about, data breaching, and there's big time problems with that. The good news is that you can go online very quickly and freeze your credit. And that way nobody can ever, add anything or steal your identity and take your stuff. The thing is, if you are going to apply for something, you're going to need to
Unfreeze it.
right? You're going to have to unfreeze it. And I think just in general is just understanding that everybody's credit is different, right? I always say credit is like your financial fingerprint.
Right.
And so there's no such thing as two of the same credit reports. And so even after doing this for 13, 14 years now, I still see things on credit reports where I'm like, what is that? Like, I haven't seen it before.
Yeah.
And so I think for especially anybody getting started in this industry, my whole thing is look at as many credit reports as humanly possible and ask lots of questions. There's lots of really good resources out there and information, but understand that credit is a very complex thing. It's very vague. It's very gray. It's very ambiguous. And so, people say, how many points will my score go down if there's no way of really knowing?
Yeah.
Something like that, or if I have a late payment, how much is it going to impact it? There's no way of really knowing because how it's going to impact yours is going to be different than how it's going to impact somebody else because the entire body of work that is your credit report. So it is a very complex thing, and it's not just a 630, 650. And also, I think the last thing that I'll add to it, Kurt, since we're up against it, is the fact that Credit Karma, free credit report, they have different scoring models, and a lot of people have that. Like I have Credit Karma, but that score is different than what a mortgage score is or what a auto loan score is. There's 4 or 5 different scoring models that are out there, and there's industry and lender specific scores. So in all actuality, you have roughly about 90 to 100 different scores as you sit right now across everything. And nobody ever knows that.
Right.
And so that's why people, I pulled my credit today, it was 650. Well, on what? Well, freecreditreport.com. Okay.
Yeah.
I've seen it 130 points either direction. Well, actually it's a 520 or actually it's a 750. And so just understand it is, again, with scoring models, everything like that, credit is very, very complex, much more complex than really anybody typically knows.
Yeah. So just to kind of wrap up with, credit is really difficult to understand, right? Basic concepts are putting credit together and making sure that you're setting yourself up for success long term, because credit allows for purchasing power, right? When, especially for typically our most expensive product, and we're biased towards mortgages because that's what we do, but you're spending money on a home that you typically will be the most money you ever spend.
Yeah.
And so having good credit really puts you in a good spot for that. And then leveraging that to make sure that you're doing things appropriately. We obviously want to encourage people to make sure they're not getting in massive amounts of debt, especially, credit cards, right? But at the end of the day, it's how can we leverage our credit to build it up appropriately and safely, right? All huge components of that. Staying underneath that 30% utilization rate, obviously super important as well. So, man, wow. I mean, I'm continuing to learn from this man, so I appreciate it myself.
Yeah, of course.
But hey, Colby, thank you so much for being here.
My pleasure.
Again, hopefully, if you guys have any questions, please reach out to us here at Mamba Mortgage. We'd love to walk you through the process. Again, how can we improve your credit to put you in a better spot. Again, if you just have questions about mortgages in general, we want to be able to help with that. And again, we're here to be a loan advisor, right? That's what we do. So I'm excited to be able to do that with my man Colby over here. And two, if you guys would please like, share, and comment here. Question of the day: who do you think makes more putts between Colby and I?
I think you already gave that one away.
Shh. Look, I could be a surprise, really good putter, right? They don't know that yet. But okay, maybe better question. Who is more likely to eat more food on the golf cart? I feel like that's a pretty good question, right?
It's probably fair.
It's probably me, but I mean, we'll just go with that. So, hey, thank you everybody for coming in today. We'll be continuing to run through some different programs, but man, I hope you learned something about credit today, and we'll see you on the next one.